When it comes to real estate investing, we're so used to talking about single family homes, apartments. Now, more and more people are looking into self storage, but really excited today to talk about something that there's not a whole lot of information on there about yet. It's a really hot topic with real estate, and that is RV park, specifically RV park investing. And I have with me today Mr. Ricky Jenkins, who's an expert in the space. So super excited for you to be here today with us, Mr. Ricky.
Thank you, Jeff. Appreciate the opportunity.
Tell us a little bit about your background and how you got into real estate.
Sure. So, graduated from the University of Texas in 1984, went to work for a commercial real estate brokerage company selling industrial properties. I knew that brokerage wasn't what I wanted to do for my entire career. I wanted to be on the ownership side and really didn't have, started with nothing, didn't have anything. A friend of mine from the company that I was working with left and went to work for a company that was a general contractor of all types of metal buildings. They started, he and I were having lunch one day. I was talking about my desire to go on my own and start putting deals together. And he said, have you checked into mini storage? And I said, no, I don't know anything about it. Long story short, I joined and this was before computers were around, but none of us were using computers. And so I joined the Texas Mini Storage Association, now the Texas Self Storage Association. Started going to conventions, talking to everybody I could. The more I dug into it, the more excited I got. I bought a big wall. They call them a key map in Houston, the big wall map of the entire city with push pins with numbers on them, and plotted. Since I couldn't do this on a computer, I plotted every storage facility in town and basically looked for holes in the market and found a deal that I liked, and didn't know that you don't ask limited partners to guarantee notes. And I certainly didn't have the wherewithal to guarantee a note. So I asked a handful of people that I called on, and they all said yes. And the deal went really well. And then just kind of snowballed from there. One of them was a wealthy Houston oil guy, and he essentially backed me on all the developments I was doing moving forward. And the industry evolved, the complexity of it evolved, and it was just me. And then over the years, the team grew and grew and grew, and now we have over 1,000 employees in self-storage and the RV park business. We built a platform of management, accounting, marketing, soup to nuts, a development team. We have civil engineers on staff, and so we sold some properties and built a fairly substantial portfolio of properties. About three, and Jeff, if it's okay, I'll kind of segue how I ended up in the RV industry. If I'm not jumping ahead here.
No, go ahead. We'll go back and backtrack. I've got some questions, but yeah, go ahead.
Sure. So about 5 years ago, I was concerned. We were the largest privately held developer of storage in Texas, and we own properties in different parts of the country as well, but we're primarily developing in Texas. I was concerned that the self-storage market was becoming overbuilt. So we pulled back, and I really enjoyed the team we built here and was looking for another asset class to transform our platform, and looked at multifamily, which I liked, looked at industrial, which I liked, but there was a lot of guys like me in those spaces, just like storage. They were very mature industries and solid, good industries, but I didn't see where there was that I would have any competitive advantage in those two industries as I would over storage. And so Troy Shepard, my COO, who's been with me for 20 years, prior is an RVer, and prior to working for me, worked for a company that had both storage and RVs. And he and others had encouraged me to look at the RVs, and I wasn't too excited. It didn't seem, as institutional as these other asset classes. And so reluctantly, I looked at it, and at the end of the day, it reminded me of storage 25 years ago. It was very fragmented, a lot of mom and pops. There, not a lot of third-party management companies, a couple of REITs, but not a bunch of REITs that participate in the space. high barriers to entry, and that the lenders aren't as familiar with it, so it's tougher to obtain financing. And what happened in storage is all the large private equity groups have entered storage, the Blackstones of the world who've invested literally billions of dollars. And so anybody with money could get into the storage space, meaning they could hire any of the REITs to manage their properties. They could hire privately held companies such as mine to manage their properties. They just, they could hire brokers to find properties. They didn't need anything but capital to enter the space. And what I really like about the RV market is that's different. You have to have an operating platform, and there's only a couple of third-party management companies, and I think the two largest maybe manage 20, 25 properties. So whereas in the self-storage world, people manage hundreds of properties, and so it would take more than just capital to enter the space, and that was appealing. So that's kind of the journey, and then I'll let you backtrack, and then we can segue more into our experience in the RV space.
Well, I'm really curious about how you got your map out, and with your push pins. How did you find? You can go online right now and go to Google Maps and do it. So how did you find the locations with no internet or anything like that?
A combination of yellow pages and a lot of driving. I mean, this is a lot of legwork, and probably took a year. And the Texas Self-Storage Association had a directory, so I just a bunch of different sources. Each push pin had a number, and I did an index card with the number, and hand wrote the address of the property, name of the property address. The push pin was blue if the property, and this was kind of in the early days of climate controlled storage. So I would use a blue push pin if it had climate, and a red push pin if it was just non-climate. And I was looking for holes in the market where I could develop high-end climate controlled facilities.
That's really impressive. So when you started, you did pretty much, were you looking to acquire? Did you acquire any existing ones and do some value add, or you did new?
I say we, it was literally just me. I only did ground up. And the first facility I built an office. So there was, an on-site apartment where the managers lived. Upstairs, downstairs was the leasing office, and I built myself an office abutting the leasing office with a window looking in, so I could learn the business. Now we have district managers and area managers and all this stuff. Back then it was just me. And frankly, the business was so green and so easy and so underserved that despite the fact that I didn't know what I was doing with my first facility, it leased up faster than any facility I've ever built. And, anybody could go in and operate a facility and do pretty well back then. That's completely changed today, but in the early days, that was the landscape.
So do you, and kind of jumping forward a little bit to the RV parks, do you see any similarities between that and the mid to late 80s with self-storage?
Yeah, yeah. Actually, that was when I left the company I was with in '89 and developed my first property in '94. So I continued to broker for a while, and then after all the research, segued into the development. The similarities are, like I mentioned, the fragmentation, the fact that demand far outseeds supply. It's easier to buy properties off market where we find better opportunities, and when a deal is brokered and publicly marketed, naturally the price is going to be more aggressive. And so there's those, and lack of sophistication of management. I mean, there's definitely some people who do a really good job in the RV space, but not as many of them today as there will be 10 years from now, in my judgment, as it becomes more sophisticated. And there's a lot of guys running around trying to do RV deals. I mean, the first RV park convention that I went, RVIC is the National Trade Association, and the first RV convention I went to, I saw 3 Texas self-storage guys there. And we're all looking at each other going, "What are you doing here?" And the answer was same thing. We were all worried about storage getting a little overbuilt and looking for other things to do. So, and there's people from all different asset classes that have attempted to enter the RV space. But one thing that's interesting is there's just a handful of owners that own more than, say, 15 RV resorts or RV parks. And the big difference in storage and RV is the brevity of the management side. It's really management intensive, and so I kind of identified that early on and built a pretty large management team in advance of our growth, so that we would do it well and make sure that all of our early deals were not learning experiences, that they were well run, and so I think what's happened in the past, if people have tried to ramp up on the RV side and build a large portfolio, and they underestimated the intensity of the management, and so we, to the tune of losing about $500,000 in our management business, and this was intentional. The first year that we operated, and about $300,000 the third, and then lost money. The second was $300,000, and then we're getting close to break even now that we have more properties. But the idea is we don't make money managing properties; we make money owning properties. Our management company is there not as a profit center, but to build the infrastructure and manage these properties the right way with the right people, right marketing, right management systems, right employee training, all that kind of stuff. And it takes a lot, and so, in a large team, and so we built that way in advance of our growth, and it's served us well so far.
So how is your company? How are you finding these off market deals? You have people cold calling or going around, or tell me what that looks like.
So it's really just industry connections. We So many deals are coming to us that we haven't had to engage somebody just a cold call. Early on, we did, and then as we became, well known in the industry, there's two large franchise business models in the industry. KOA, the one that everybody knows of, has over 500 franchise locations. The first property we bought was a KOA, so we attend all of their convention and different things, and so we're well known within the KOA community, and those owners will come to us directly. And then the other franchise model is Leisure Systems, which operates the Yogi Bear Jellystone parks. And one of our early hires was Kelly Jones, who was the vice president of operations with Leisure Systems. So one of her roles with that company was to visit on a rotating basis all the Jellystone parks, give the owners an assessment, and work directly with the owners on how they can improve their operations. And so Kelly knows all these owners, and she's also has been an instructor at Arvix National School for many years, and so she's also instructed a lot of these owners and most of the people we buy. And so that, appraisers that we work with, industry. One thing I did in researching this business is I started Googling industry consultants, and I found about 5 people that seemed to be the 5 predominant industry consultants. I interviewed all of them. I hired 3 of them to help me write a business plan and just bring me up to speed as quickly as I could. And so, those consultants that we work with, so just, our insurance guy, just all types of people, software provider, all sorts of people know that we're an active buyer. And so we get just a lot of direct deals come in the door through all those resources.
And I was mentioning to you before we started recording how I went to South Louisiana last week with Chris Rude, who's got about, I think, $30 million worth of mobile home parks, and to spend the day to see his operation. And we actually spent a little more time, about half the time, looking at RV parks, and he made 2 offers on RV parks in Lake Charles area. And my thinking of an RV park was sort of what we went to. It was mom and pop. It was both of them, 2 old guys owned them. They were looking to get out. Their health wasn't too great. They wanted to travel more, but they wanted a lot of money for it. I think they wanted like around a 6 or 7 cap, and he was wanting to buy it at around a 15 or more cap. So they couldn't come to terms. But anyway, just just, kind of walking the park and looking at how both were distressed, but there was opportunities. So that was my thinking of what these parks look like. But I look at some of the ones that you have. I mean, these are like, Disney World type resorts. So are y'all looking more to buy things like the distress and really ramp them, or are you looking more that are already established, or what are your thinkings about that?
Sure. So we will do either, and we're also developing ground up. And I'll back up and I'll just kind of ramp you up to where we are, and it'll in effect answer your question. So the first park we bought was the KOA in Colorado Springs. The second one we bought was called Yogi on the Lake in Pelahatchie, Mississippi. It's a Yogi Bear Jellystone park. And then, so we bought a series of kind of one-off opportunities, and then opportunity zones came to light. And we formed and so we were just putting together single asset entity partnerships to buy our initial properties. And then we decided to form an opportunity zone fund to do 3 developments, 2 in the Austin area and 1 in Bryan College Station, where Texas A&M University is. And then we did a second opportunity zone fund that was actually just 1 property, but it was for development of a property outside on the Tennessee River outside of Knoxville. That was brought to us by one of these consultants that really liked the deal, but the developer was a single family lot developer and didn't want to take on an RV park development. And then our 5th development is a joint venture with a self-storage investor of ours in the San Antonio area. But so we started buying all different types of parks, and there's essentially 3 types of park. There's what I'm going to call monthly extended stay parks, where it can either be, South Texas or Florida. Snowbirds come down from the winter and spend the winter season, and they leave, and they pay a seasonal rate. And then one of the parks that we bought outside of Austin is a monthly park that's essentially operates like a manufactured housing community. It's people that are, cost of living can be very high in Austin. These people are essentially living in their RVs and commuting to work in Austin. So that's what I'm going to call monthly seasonal parks. And then the second type of park is a transient park, which is like the KOA in Colorado Springs. People are coming to our park, leaving during the day, visiting, Pikes Peak, Garden of the Gods, all the different tourist things there are to do in the Colorado Springs area, coming back at the end of the day, spending 2 or 3 nights and leaving. And then the third type of park is a destination family-oriented type park, and which is exactly what the Yogi Bear Jellystone brand is. People are coming to the park. They're generally not leaving. The idea is they're spending their vacation dollars with you, but you've got to provide a lot of amenities, a lot of activities. And we have activities on the hour all day for the kids. Mom books the space, her and dad can go hang out at the pool, have a cold one, and we can do fun things with our kids all day. And like laser tag. We have small, and like you mentioned, these are kind of on steroids. We have small water parks. We have gaga ball pits. We have jumping pillows. We have, we do hay rides. I mean, you name it. Like if a park has any topography, and we have themed weekends, like we'll have a chocolate weekend, and we'll do a slip and slide that's covered with, like chocolate jello, and the kids are sliding down there just a mess. Or we might do, instead of mud wrestling, fill it with chocolate jello and do chocolate wrestling, and just all this different stuff. And so those are the 3 types of parks. And we since the destination family oriented parks are so hard to manage, we view that as a barrier to entry. So we really like that type of park. But just to give you an idea of the scale, a development of one of those is a $30 million plus development. Like the one in Watts, Tennessee that we're doing, 2 of the ones in Texas we're doing, those are all 3 $30 million plus developments. And then, a lot of times we are buying a value add type park. We're just looking for good bones, a good location, a pretty setting, and we'll come in and expand the park, add all these amenities. And, like it's not uncommon for us to pay $5 million for a park and spend another $15 million on the park, adding a clubhouse, resort style pool, a small water park, cabins. And that's become a big deal in the RV park industry. Is they're technically called park models. They look like a tiny home. And a park model is a titled RV. So they come in on wheels, we remove it, skirt them. We buy ones that look like that are essentially a log cabin. And so the advantage of that is it greatly increases our market size, because you don't have to own an RV. You can come to our park, stay in one of those cabins for the same price that you might rent a limited stay hotel. And so for $160 a night, you've got your family of four, your pets, you have a kitchen, you bring your food. The thing about what's appealing and what's driving a lot of the market demand of the RV space is that it's affordable travel and vacations. And most people think that, or when I certainly started looking at the business, I was thinking your average RVer was a retiree driving a Class A motorhome, when in fact the opposite is true. Millennials and Gen X are the biggest part of our market, and they drive they have a $25,000 fifth wheel that they're pulling, and so they can tax title license drive out. They can go buy a $25,000 fifth wheel, finance it. Their payment's $200 a month. Then go rent an RV space for $60, $70 a night. Take their family, their kids, their pets, their food. I mean, it's by far the least expensive way they can travel and have a quality experience. And with respect to the cabins, they can stay in like I said, they can stay in our RV park, have all these amenities for the same price that they could stay at a Holiday Inn Express. So it's really a good value to the customer. And quite frankly, I'm not an RVer, never was an RVer. When we got in this business, my wife was encouraging me to rent an RV and go on a trip, and I'm like, okay, I'll do it. And so we got our adult kids. There were 6 of us and their spouses, son, daughter, husband, their husband and wife, and wife and husband, and set out on this week-long RV adventure. And the thing that really struck me about it is you pull into these RV parks, and it's like when you and I, or maybe, I think I'm a lot older than you, but maybe when I was a kid, and you come home from school and you run out the door and look for your friends to play. You don't get on your electronics. You're not staring at your phone. And so it really was a great environment to me, and that people were in the outdoors, talking to their neighbors, doing things that I think are wholesome and mentally stimulating, and parents like seeing their kids do that kind of thing. And so, that was really appealing to me about the business. And I think a big driver of a lot of the, other than affordability, just the quality of the experience. And people, I didn't know how to drive an RV, and I'm trying to back into the space and hook my sewer and water hoses up. And I had 3 neighbors over there. It was pretty obvious to them I didn't know what the heck I was doing. And, your neighbor's there to help, and, and all that kind of stuff. And it was a great experience.
That's awesome. So you said you sort of got into it pre-pandemic. Tell me a little bit about what you're seeing as far as now post-pandemic, with people, they were cooped up, they want to get out of the house, they have this extra money that was pumped in. So what are the differences that you've seen?
Yeah. So, what happened during the pandemic was people were worried about travel. They wanted to control the environment. If they were going to, they didn't want to get on a plane. They didn't want to stay in a hotel room. So RVs were, depending on where you were and the government regulations on whether or not you could have your pool open and things like that, it was a boon for the industry. But the long-term boon for the industry is that RV sales went through the roof and are still through the roof, and have set records each of the last several years, and they're going to be at all-time highs moving forward. And so it exposed a lot of people to the industry that weren't RVers before. And, I don't know that they'll all stick, but a lot of them will, because it's, like I mentioned, it's a great experience. And so, it's really ramped up demand. Like our reservations, are up for this summer compared to last summer, and last summer was a record summer. And so the challenge in this space is not, like, if you have a good RV park that's what I'm going to call the destination or transient type location, you should be full every weekend. So the challenge is, how do you increase midweek stays? And we believe that's with amenities and, enhanced Wi-Fi. A lot of these older, you mentioned the two owners that you observed were older people that were ready to get out. And that's almost always who we buy from. It's a couple that's operated the park for a long time. It's outdoor hospitality. It's hard. It's not an easy business to operate these parks. And so they're tired. They're ready to retire and move on. And so we can, and a lot of those owners don't understand the importance of number one, digital marketing, but number two, the Wi-Fi and how important that is. And now that people, it's also been great for us, back to your original question, and that people can work, a lot of people can work from anywhere. And so they can be traveling with their spouse or their family and still working. And we believe that really good high-speed internet Wi-Fi is important for that. So, that's one of the first things we consider that almost like another utility. So we bring that in and do that, and then expand all of our other amenities, which gives people more things to do, which hopefully will lead to longer stays.
Yeah, because there's, as you mentioned, the people that you thought was more retirees, but in the space that I'm teaching people about passive income, financial independence, what I'm noticing that the people that are retiring, these are physicians, dentists, engineers, attorneys. They're retiring. They're young, in their 30s and 40s. They're becoming financially independent. They're pretty much selling it all, getting an RV and enjoying themselves.
Exactly.
You're seeing that a lot online. So that was really cool to see that. You had mentioned that you had some opportunity funds and some funds in the past, or were those ways for people that wanted to invest with your group could do that, or not?
Yes, so that's what we do is we initially were buying, as I mentioned, one-off properties, and then we just saw such a large opportunity. We made the decision that for both our lenders and our investors, we could mitigate risk by doing a series of funds. So we did a $100 million fund, which was our first two funds were opportunity zone funds, and then our first and those were both development deals. Our first acquisition fund was Great Escapes RV Fund 3. That was a $100 million fund. We bought all the properties and placed all the money from that fund, and we're now doing Fund 4, which is a $250 million fund, which will be $100 million in equity and $150 million in debt. And so we purchased our first property in that fund last week. We're purchasing the second next week. And then we will, so there is investment opportunity right now through that fund, but moving forward, we will just do a series of funds. And most of our investors are high net worth people that have a lot of disposable income and investment income, and they're not looking for to get in and out. They're looking for long-term cash flow. And so all of our funds are designed for long-term cash flow, because these are people that are the people we work with. If they sold, they'd just be trying to figure out what they're going to do with the money next. And so the idea of selling isn't their highest. While we can generate better short-term IRRs, it's still the same thing. What do you do with the money after you sell? So we're buying these properties with the idea that we will operate them for for long periods of time and just do it for cash flow.
So what's a typical fund look like as far as hold time, cash flow? Is it like monthly? Is it quarterly? Minimum
we do.
investment?
So our just to get right into the weeds, our fund, our terms are the investor receives a 7% preferred return. It's a 60-40 split, 60% of the cash flow and proceeds to the investor, 40% to us as the GP. We do quarterly distributions the first few years of the fund. So, we're targeting value add because you end up with higher. If we find a good deal that's, you mentioned a 15 cap. I haven't seen one of those. We have a hard time finding 6 or 7 caps, even on properties that you would think would trade at 15s. And so, we're looking for we look at what the cash flow is 3 to 5 years out, not day one. So we're really more focused on, as opposed to, day one cap rate. We're really more focused on year 3 through 5 potential returns and how much we're paying per site. One thing that's happened is there's been another barrier to entry is through the pandemic and all, with all this inflation, construction prices are just through the roof. So it's tough to build. I mean, it's harder than ever to do a new development and get the returns that you could have gotten pre-pandemic. So
Right.
we think that's going to be a barrier to entry. And the only way a development deal works in the RV space now, in my opinion, is to build a very large scale development. This $30 million plus type development. You've got to get economies of scale with today's construction pricing to make good returns. And so other than mom and pops that may go get an SBA loan and operate it themselves, or they're almost kind of creating a job for themselves, I don't think while there's a lot of guys out there trying to develop, I think once they get into it and see the actual costs and returns, I think it'll shy people away from development. So, value add acquisitions are really where we're focused.
Okay, excellent. Now, if people want to learn more about what you do or your company, how do they do that?
Sure. I mean, our website is jenkinsorg.com, JENKINSORG.com.
Okay.
And they can reach out to me directly at 713-622-6688, extension 5. I'd be happy to talk to them about it. And Jeff, I can send you our fund package. I don't know exactly how you work, but I'm happy to send you a fund package that you're welcome to share with anybody that reaches out to you.
Yeah, I'll just put a link below this video so people can read more about you if they want to contact you directly and learn more about this space, because this is brand new to me too. But I think it's, like I said, but before the call, it's really exciting to see such low competition yet high potential. So I think that's really cool.
Sure. And post it, if you would, post my email address. That's probably the best way to.
Okay.
I frankly get so many sales calls that if you call that number I gave out, I'm not going to answer. I'm going to listen to my voicemails and make sure it wasn't a sales call and call people back. But email is really the best way to reach me.
Okay, perfect.